Okay, so hello my dear students. So welcome to another discussion for accounting for business combination. So this is actually still in continuation for accounting for stock acquisition subsequent to the date of acquisition. So in the previous video, we have discussed an illustration on 100% stock acquisition, di ba? Pero the method na ginamit natin is cost method. Okay, so in this video, we're actually using the same illustration, but we are to use equity method in accounting for the investment account in the separate financial statements of the parent. Okay, but it should be noted that whether we use equity method or cost method in accounting for equity investment in subsidiary account in the books of the parent, the consolidated balance is actually the same. So whether we use cost model or equity model, kasi diba, we are to eliminate lang din naman the reciprocal accounts, meaning to say, eliminate natin yung equity account in subsidiary, and then yung investment account in the books of the parent. So, the process is actually the same, but mag-differ lang tayo in the eliminating entries and some worksheet. Sa worksheet kasi nga, iba yung entries, di ba? If we apply cost model and equity model in accounting for investment in subsidiary account in the books of the parent. Okay, so we have here it's actually the same illustration that we had on the previous video. So assume that Perfect Company acquires all of Sun Company's common stock on January 1, 2014, for 387,500, an amount 87,500 in excess of the book value. Okay, so the acquisition price include cash of 300,000 in a 30-day note for 87,500. So it was paid at maturity. So at the end of 2014, Perfect Management determines that a 3,000 goodwill impairment loss should be recognized in the consolidated income statement. So we have here some assets and liabilities that their book values were different from the respective fair values. Okay, so to compute for the goodwill, so we have book value for net assets of 300,000. And then we have here the excess, or yung excess of the fair value in the cost, of some assets and liabilities. So we have here yung inventory is undervalued by 5,000, yung land is undervalued by 6,000, yung equipment is undervalued by 80,000, yung building is overvalued by 20,000, and the bonds is overvalued by 4,000. So the net undervaluation of our net assets is actually 75,000. So we have fair value of our net assets, which is 375,000. Okay, so this is 100% stock acquisition. So the formula for determining the goodwill is actually consideration transferred, which is 387,500, less the fair value of our net assets, which is 375,000. So we have a goodwill of 12,500. Okay, so we have here some data. Now we have here some data of the income statement of the parent in the subsidiary, it's actually on December 31, 2014. So we have here the net income of the parent, which is 176,000, and also the net income of the subsidiary, which is 50,000. So you take note that kasi on the cost method, yung income ni parent kay subsidiary is actually its dividend income, So under equity method, the parent will have a share in net income of the subsidiary, So as you notice, ang net income ng subsidiary in its own operation is 50,000, But the parent will record the income, the income of the subsidiary, net of the amortization of excess and the impairment loss. So, di ba? We have amortization of excess of 11,000. So, this composed of yung inventory, which is uh, undervalued siya by 5,000. So, therefore, the cost of goods sold is understated also. So, and then, yung equipment natin, di ba, yung equipment is undervalued by 80,000. So, divide 8 years as useful life. So, we have 10,000 na understated yung depreciation expense natin. Okay, so yung buildings, diba, overvalued siya by 20,000. So, divide 4. Therefore, our depreciation expense is overvalued by 5,000. So, it's actually a 5,000 net understatement of our depreciation expense. Okay, and then our bonds payable, or the discount on bonds payable, no, which is actually 4,000, divide 4 na term ng which is the life of the bonds. So we have 1,000 as our amortization of our discount. So we have 11,000 all in all as our amortization of excess, which actually decreases the net income of the subsidiary. Okay, so plus the impairment loss of 3,000. So kasi goodwill is impaired by 3,000. So we have 14,000. So the parent will record the income of the subsidiary, diba? At its net income less the amortization of excess and then the impairment loss. So we have 14,000. That's why the parent recorded 36,000. Okay? Kasi if it was cost method, 'di ba, ang income ni parent from the subsidiary is the dividend. No? Kasi sa equity method naman, 'di ba yung dividend is actually a return of investment. So, but in equity method, the parent will have a share in the adjusted net income of the subsidiary. Okay? That's why, no, so yung entry ni parent, no, so yung entry ni parent. So first, on the first year of acquisition, no, so first, to record the investment, shall debit investment in Sun Company for 387,500, credit siya na siyang cash for 300,000, and a credit to notes payable of 87,500. Okay? And then, to record the dividends, no, so since the dividends is treated as a return of investment, so ang entry niya is a debit to cash and a credit to investment in Sun Company for 30,000. Okay? Yung dividends. Okay? Diba, as what I've said kanina, under equity model or method, the parent will have a share, in the adjusted net income of the subsidiary. Okay? So, the first entry is to recognize, not record, share in the net income of the subsidiary. That's actually 50,000, diba? Kasi 50,000 yung income ni subsidiary. Okay? That's, the other would be a debit to investment in Sun Company and a credit to investment income. Also, the parent will record the amortization of excess, which is actually 14,000, diba? That's 11,000 of amortization of excess and the 3,000 na impairment of our goodwill. So, then it will decrease the investment income. That's why, diba, the investment income is 36,000. It's actually 50,000 less 14,000. Okay? Let's discuss eliminating entries, no? Yan. So, actually, may similarities din yung eliminating entries ng cost model and equity model. So the first eliminating entry, for the first year of acquisition, is actually to eliminate the equity accounts of the subsidiary against the investment account. Okay. So ito yung equity account of subsidiary, that's a debit to common stock and debit to retained earnings, and a credit to investment. Yan. For 300,000. And then, the second entry to adjust the book value of the subsidiary's fair value, diba? So, i-recognize natin, diba? We have net undervaluation of our net assets of 75,000, okay? It's actually to record the inventory, undervaluation for inventory of 5,000. Yung equipment natin, is actually undervalued by 80,000. So, i-debit na siya to accumulate depreciation. And then, yung building natin is actually overvalued by 20,000. So first, our entry would be debit to accumulated depreciation buildings. Then yung cost niya to make it 120, i-credit natin by 180. Then yung bonds is actually overvalued by ano 4,000. So since the fair value is lesser than the book value, then therefore yung excess or difference ng book value at fair value ng bonds is actually a discount on bonds payable. Then also the land is undervalued by 6,000. So the net undervaluation of the net assets shall be credited to investment in some company for 75,000. Okay, so the third entry is actually to recognize the goodwill. Now we have computed. It's actually a debit to goodwill and a credit to investment in some company. Okay, to take note that the purpose of our eliminating entries is to first eliminate the equity account of the subsidiary against the investment account, and also to recognize the difference of the book value and fair values of the assets and liabilities of the subsidiary at the date of acquisition and to recognize goodwill. Okay, but in the eliminating entries in the subsequent to the date of acquisitions, we are to amortize the excess. So, diba, this is actually the entry for the amortization of excess and the recognition of the impairment loss. Okay, so first, diba, we have yung inventory natin. So, yung inventory, so to record the excess, it's actually a debit to cost of goods sold and a credit to inventory. Yan. Okay, as to equipment and buildings, so yung equipment kasi yung net depreciation expense, diba? Kasi we have 5,000. So, but for the building, is actually to adjust, is actually a debit to depreciation, for the equipment rather, is actually a debit to depreciation expense of 10,000 and a credit to accumulated depreciation equipment for 10,000. Since, diba, pag undervalued yung asset, undervalued din yung depreciation. Okay. And for the building, since it's overvalued in yung depreciation. So, the record that one is actually a debit to accumulated depreciation building at 5,000, credit depreciation expense for 5,000. But itong depreciation, gilump natin to. I mean net. Ginet natin siya from the depreciation ni equipment. Yan siya. As to bonds, the entry for the amortization of their discount on bonds payable is actually a debit to interest expense and a credit to discount on bonds payable. Okay, as to impairment loss, that would be the goodwill impairment loss and a credit to goodwill. Okay, it's actually the amortization of excess for the first year of acquisition. Okay. The last entry is to eliminate the investment income and dividends paid. So, eliminate natin yung investment income ni parent, also the dividends paid ni son company. So, and then the excess is actually yung share ni non-controlling interest sa dividends. It's actually 30,000 times 20%. Ito siya. So, ang excess will be credit to investment in some company. Okay. So, as to worksheet, and so we have our worksheet. So, the process still the same, diba? You have to combine the accounts. Then, we'll take into consideration lang the effects of our eliminating entries in our consolidated column. Uh, but if there's, if walang effect yung if walang eliminating entries, simply combine the accounts for the parent and the subsidiary. So, let's start with the income statement. Yan siya. So, we have sales of 400 and 200. It's actually 600,000. Yung investment income natin, di ba, i-eliminate man siya. So, consolidated, wala na. Okay? Yung cost of goods sold natin, we have 170 plus 115 plus 5 na amortization. Yung sa inventory, it's actually 290,000. Yung depreciation natin, that's 50 plus 20 plus 5. This is actually the amortization of the expense in the building. That's actually 75,000. You have interest expense of 1,000. That's actually the amortization of the discount on bonds payable. We have other expenses of 40 plus 15. It's actually 55,000. And a goodwill impairment loss of 3,000. Okay? So, you take a look, di ba? The consolidated net income attributable to parent, no? It's actually 176,000. It's actually the same with the net income of the subsidiary, no? And of the parent. So, same, no? Kasi, di ba, the parent recorded already its share in net income. So, however, i-eliminate man din yan siya, but the process of eliminating entries, no, will still provide, no, also give us the consolidated net income of 176,000. Okay. The statement of retained earnings, no, we have eliminated, diba, the retained earnings of the subsidiary. That's actually 100,000, no? And then, so forward na lang ang retained earnings yung kay parent. Then, the adjusted net income of 176,000. Or, yan. Then, since itong dividend paid ni subsidiary is may eliminate, so forward na lang is yung kay parent. So, we have 416,000 na retained earnings consolidated. Okay, so notice the retained earnings consolidated is actually the same with the retained earnings consolidated, retained earnings balance presented in the separate financial statements of the parent. So, yung ending balance ng retained earnings ni parent is actually the same na with the consolidated balances. So, yan siya. As to our balance sheet, no, so we are to combine lang sa some assets, no, or liabilities accounts, no. So we have cash here, 122,575, that's 127,500. Yung accounts receivable natin, 75 plus 50, that's 125. Yung inventory natin, that's 100 plus 75, plus 5 less 5, no. 5 kasi to recognize the difference in the book value and fair value, no, and then yung amortization niya of the excess, still have 175. The land is 175,000 plus 40,000 plus yung 6,000. You have 221,000. Yung equipment na 200,000 and 150,000, we have 350,000. Okay? So, the building, we have 600,000 plus 40,000 less 180,000, so we have 870,000. Yung discount on bonds payable naman natin, we have 4,000 less amortization of 1,000. So, the balance na is 3,000. Okay? As to goodwill, we have 12,500. We recognize 12,500. And then, less 3,000 na impairment loss, we have 9,500. Okay? We have actually balance of investment in some company of 383,500. So the 303,500 actually is the balance actually. Ito yun siya, no? Di ba we have debited 387,500 to record the acquisition of Sun Company. And then to record the dividends, debited cash and credited investment account. And then to record the share in net income, yung net, that's a debit to investment in subsidiary or investment in Sun Company credit investment income. Therefore, the balance of our investment account is 393,500. Okay, but diba, the purpose of our eliminating entries is to eliminate the investment account. So from our eliminating entries here, no. So in the first entry we have credited 300,000, and then the second entry we have credited 75,000. Also the third entry we have credited 12,500, and then the last entry we have credited 6,000. So that's actually total 393,500. No, so therefore may eliminate yung investment account. Okay. As for the liabilities, no, and owner's equity account, no, so for accumulated depreciation equipment, we have 112,500 plus 80,000 less 80,000 plus 10,000. So this this 80,000 na yung excess. Actually, i-amortize natin siya. So the first year, the amortization is 10,000. Okay? Yan siya. So the balance is 122,500. For the accumulated depreciation building, we have 337,500 plus 240,000 minus 160,000 minus 5,000. Actually, 412,500. Okay? So yung accounts payable natin is actually 200,000. Then yung bonds payable natin is actually 300,000. So since may eliminate itong common stock ni subsidiary, so mga forward na is yung kay parent. And then yung retained earnings computed natin kanina for 16,000. So we have 1,051,000 as a total, no, in our consolidated column for the balance sheet. Yan siya. So again, no, the purpose of our worksheet is to eliminate, diba? Eliminate the investment account, and then establish goodwill and to record the amortization of our excess. So, kasi, di ba yung sa books sa subsidiary, naka-book value kasi yun, di ba? Naka-book value. So, therefore, in preparing consolidated financial statements, dapat i-convert natin siya to fair value. Okay? So, to prepare for the income statement for 2014, no, so you can actually have the balances. You may refer to the worksheet column, yan siya. So we have sales of 600,000, yan siya. And then we have cost of goods sold of 290,000, yan siya. And then the expenses, no, have here expenses. The total expenses actually, total cost and expenses actually 424,000. It's the cost of goods sold and the some of the expenses, depreciation, interest, goodwill, and other expenses. So again, you may refer this to your worksheet. As to preparation of the balance sheet. No? So the figures, you can actually refer this to your worksheet. Okay. So you have total assets of 1,413,000. Okay. Again, you may refer this into your worksheet. Yung balances natin. Okay. So you have here some data for the parent and the subsidiary for the year 2015, the second year, no, after the acquisition. So we have here the net income of the subsidiary, which is 229,000. The parent rather, that's 229,000. It's net. Then the net income of the subsidiary is actually 75,000. Okay. So how would the ano yung entries natin in the books of the parent for the year 2015, no, the second year of the acquisition? Okay, so you have first entry, no, to record the dividends, diba? So that's a debit to investment, a debit to cash, and a credit to investment in Sun Company, no. for 40,000. Ito yung entry natin to um, record the dividends. And to record its share in net income, no? To record its share in net income. Okay, so to record its share in net income, di ba? Kasi debit ko investment in Sun Company and credit investment income for 75,000. Okay? Kasi di ba, the net income of subsidiary 75,000. Okay? And then, di ba, i-record niya yung excess. So, for the second year, ang excess na is ano na lang, 6,000. No? Kasi wala na itong, kasi yung inventory, fully amortized na yan siya at the year 2014. So, sa subsequent year, yung ano na lang, kasi yung, di ba yung life niya is 1 year lang. So, we have, ano na lang, depreciation of 5,000, no? And then the interest expense of 1,000. So, that's why yung investment income nag-record ni parent is only 69,000. It's actually 75,000 of unadjusted net income of the subsidiary less 6,000 of the amortization of the excess. Okay? So, to determine the balance of our investment account, no, so we have actually 393,500 as the balance, diba? For the last year, that's 393,500. So, diba? Kasi the worksheet limiting entries natin, no, and that's actually for consolidation purpose lang. So, the consolidating entries or the worksheet, the working paper limiting entries will not affect the separate FS of the parent and subsidiary. Okay? So, hindi siya maka-affect sa balances of the two companies. The working paper limiting entries is actually for lang siya, no, for the preparation of consolidated financial statements. So, kaya the balance of our investment account is actually 393,500. Okay? Less dividends of 40,000 and then plus its share of net income of 69,000. So, we have a balance of 422,500. Okay? Okay, so we have here our eliminating entry, diba? No? So, first is to eliminate the equity account, no? Equity account of the subsidiary against investment account. Okay. Second entry is still is to establish the difference of the fair value and the book value existed at date of acquisition of some assets and liabilities of the subsidiary. Okay. And then the third entry is to recognize goodwill. No? Okay. Okay, so in the fourth entry, ito siya. Our fourth entry kasi diba is to recognize the amortization of excess. So, but in this case, yung amortization of excess natin, actually it's for 2 years already. We are now in our second year of the amortization for excess. Okay. So, sa previous year, di ba, we have 14,000 no? Kasi we have 11,000 na amortization plus 3,000 na 3,000 na impairment of the goodwill. So for the previous year, we shall debit it to investment in Sun account, no? Yan siya. But for the current year, for the 6,000 for the current year, no? For the 6,000 for the current year, so of course, for the depreciation, the net depreciation will debit into depreciation expense, and then for the amortization of early discount is actually 1,000. Okay. But the related related entry niya, so say for example for for the inventory kasi i-amortize man yun siya. But for the equipment, ang i-credit mo is actually 20,000 na. No? Kasi second year naman ito. So we have, di ba, we have 10,000 per year. It's actually times 2, so 20,000 na. No? So that's actually 10,000 for the current year and 10,000 sa previous year, which is included here, no? Sa 14,000 yung previous year. So parang sa previous year, i-debit mo sa investment account, ang sa current year, i-debit mo sa expense account. Also for the building, It's actually 10,000 na. No? Kasi that's actually 5,000 times 2. Diba? And then for the discount on bonds payable, yeah, that's 2,000 already. Kasi second year na. Then, shall credit goodwill for 3,000. Okay? Yan siya. And also, the last entry is to eliminate the investment income. That's actually 69,000, diba? Against dividends paid. Dividends paid ni Sun. No? Actually, the difference niya, it shall be credited to investment in Sun Company. It's actually 29,000. Okay? So, in our worksheet, no, same pa din, no, you are to combine the balances, no, for the parent and the subsidiary. So, for the income statement, combine lang man natin siya para i-take effect natin at yung working paper eliminating entries. So, for the sales, you have 750. Then, di ba, i-eliminate natin itong 69,000 na investment income. Yan siya. And then, we have cost of goods sold of 180 plus 160, that's 340. We have depreciation of 50 and 20 plus 5. 75, and then there's expense of 1,000, and then yung other expenses we have 60,000 plus 45,000 plus 105,000. So we have total cost and expenses of 521,000. Okay, we have consolidated net income of 229,000. So again, it's actually the same sa report ni parent na net income. Okay. Also, for our statement of retained earnings, yun siya. So, we have eliminated, diba, the retained earnings of the subsidiary. So, we have 416,000 as our beginning retained earnings. So, this is actually the same with the consolidated retained earnings natin. It's 416,000 plus the net income computed kanina is 229,000 less dividends declared ni parent, which is 60,000. So, kasi ma-eliminate itong 40,000 na dividends ni subsidiary. Okay? It's actually 585,000. Yan yung balance. As to balance sheet account, it was same process. You are to combine the balances for the parent and subsidiary. So, you have cash, we have 240 to 500. Then for accounts receivable, diba, that's actually 230,000. For inventory, that's 180 plus 90, plus 270. Kasi we have debited and credited 5,000 at the same time. And then for land, we have 125 plus 40 plus 6 is 221,000. For equipment, still we have 350,000. For building, we have 870,000. As to discount, no, so we have debited 4,000 but credited 2,000. So, the amortizations, we have 2,000 na lang. Then, goodwill natin still battery at 9,500. That's 12,500 na goodwill less less impairment of 3,000. And then, di ba, the balance of our investment is 422,500. No? So, you are to eliminate that one. So, our entries, no? So, we have, ang entries natin, or limiting entries natin would, eliminate, diba, the investment in Sun Company. So, it's actually a credit to 320 plus 75 plus 12,500 plus 29,000 less 14,000, no? Actually, 422,500, no? So, therefore, na-eliminate na ang investment account. So, okay, as to, balances, with the credit side, yung accumulated depreciation equipment natin is 125 plus 85. Then debit 80,000 plus 20,000. So minus 80,000 is it's plus 20. That's 150. As to the building, we have 375 plus 255 minus 60 minus 10. Actually 460,000. Yung accounts payable natin 200,000. Siya 200,000, and then bonds payable 200 and 100, that's actually 300,000. Yung common stock is common stock lang ni parent kasi ma-eliminate yung kay subsidiary. And then your retained earnings computed then. So we have 2,195,000 as the balance. in the consolidated column. Okay? For the preparation of our income statement, no, again, you may refer this one to the worksheet column here. The worksheet in the consolidated column to have the balances. No? And then again, for the balance sheet, still, you may refer this one, no, the balances in the balance sheet um, columns in your consolidated worksheet. Okay, yun siya. So, yan, we've discussed na equity method of accounting, no, for 100% stock acquisition. So, in the next video, we shall have a partially owned corporation naman. Both, whether we use full goodwill or partial goodwill, and then using cost model and equity model. So, again, thank you for listening.